50,000 euros. That is a realistic impersonation scam loss in a single incident. Under PSR, if your controls were not good enough, that is yours to refund. The Payment Services Regulation, PSR, has rewritten the liability rulebook for payment fraud across the EU. And the key rule that every bank, fintech, and e-money institution needs to understand is the impersonation fraud provision. For decades, the standard defense was simple. The customer approved the payment. PSR has made that defense significantly weaker, in some cases worthless, when the customer was manipulated into approving it. If you run fraud operations, build fraud controls, handle complaints, or manage risk at a PSP, your entire approach to reimbursement decisions, control design, and supervisory evidence needs to change. This episode is the operational guide. Fraud and claims professionals watching this. When you look at your current impersonation fraud cases, how many of them would require reimbursement under PSR's liability rules? Drop your honest estimate in the comments. The gap between where most institutions are today and where PSR puts them is real. To understand PSR's liability logic, you need to start with the distinction between unauthorized and authorized transactions. An unauthorized transaction is classic fraud. Someone else used the customer's details without their knowledge. Card cloning, account takeover, credential theft. PSD2 already gave customers strong protection against those. Authorized push payment scams, app scams, are completely different. The customer knowingly logs in, knowingly enters the details, and knowingly presses confirm. They are doing what the fraudster, posing as someone trusted, has coached them to do. Under old frameworks, because the customer authorized it, liability sat largely with them. PSR changes that calculus. Here is the impersonation fraud rule in plain language. If a customer is deceived by someone posing as their payment service provider, whether that is the bank, the fintech, or anyone acting as a PSP representative, and the customer reports the incident to both the police and to the PSP, then the PSP is expected to refund the full loss. That is the default position under PSR. Why does PSR put the liability on the PSP? The rationale is logical. The customer was targeted precisely because of the trust they placed in your brand and your institution. The PSP is best positioned to implement technical and procedural defenses against impersonation, and the PSP has the deepest knowledge of what genuine and fraudulent interactions look like, so the PSP bears the primary responsibility. But there are edge conditions where the liability picture becomes more nuanced. What if your institution displayed a clear, prominent fraud warning, and the customer dismissed it multiple times? What if the customer had previously been warned about this exact scam typology? PSR does not say the PSP always pays regardless of anything. Customer behavior that amounts to gross negligence or deliberate disregard can affect the outcome. What if the customer delayed reporting? PSR expects the customer to report to both the police and the PSP. If a customer waits 3 months to report an incident they were aware of, that delay matters for evidence and for the assessment of the claim. Your reimbursement policies need to define what prompt reporting means in practice. PSR introduces a concept that will drive supervisory conversations for years: appropriate fraud prevention mechanisms. Your liability exposure is directly connected to whether your controls meet that standard. So what does it mean in practice? First, strong customer authentication. PSR does not just want SCA in place, it wants SCA that is risk-calibrated and resistant to social engineering. A static SMS code that a fraudster can coach a customer to read aloud is not sufficient. SCA needs to involve elements that adapt to transaction risk, device trust, and behavioral patterns. Second, real-time transaction monitoring. With instant payments, you cannot monitor in batch and hope to intervene. Your fraud engine must be able to score, flag, and optionally delay a payment in real time, within the processing window, based on risk signals including payee profile, customer behavior, velocity, and VOP outcomes. Third, spending limits, transaction caps, and cooling off options. Offering customers the ability to set their own limits and giving them a cooling off window on high-value new payee transfers is a concrete and documentable control. Supervisors will look for this as evidence of proportionate risk management. Fourth, clear and timely fraud warnings at high-risk moments. A warning that says, "Please check the payee details" in small gray text is not appropriate. A warning that says, "We have detected this is a new payee receiving a large payment. Have you verified by phone who you are sending to?" That is appropriate. The content, placement, and prominence of warnings matter. How will supervisors decide if your controls are appropriate Expect benchmarking against industry peers, thematic reviews comparing fraud loss rates and control designs across institutions, and deep dives after significant incidents. They will look at your monitoring performance data, your warning designs, your override rates, and your model documentation. This is not a one-time audit, it is an ongoing evidential standard. Let me walk you through 4 case archetypes showing how PSR's liability logic applies. Case 1. The classic impersonation call. A customer receives a call from a number that appears to be their bank. The caller says there are suspicious transactions on their account. They are guided through SCA and instructed to move funds to a safe account. The payment is made, the money is gone. Under PSR, the fraudster impersonated the PSP. The customer reported to both police and the bank. If the bank's controls, SCA design, monitoring, warnings, did not adequately defend against the known risk of impersonation calls, the default outcome is reimbursement. Improvement actions, SCA resistant to voice coaching, real-time call spoofing signals, and a direct callback option before high-value payments. Case 2. An investment scam originating from a platform advertisement. The customer sees what looks like a regulated investment opportunity on a social platform. They contact the broker, transfer funds through your PSP, and later discover the platform and broker were fraudulent. The social engineering happened entirely off your platform. Under PSR, the liability picture is multi-dimensional. The platform that hosted the ad may face liability toward the PSP if it failed to remove fraudulent content after notification. The PSP needs to document whether it had processes to detect this type of scam, whether it notified the platform, and what its monitoring showed. The evidence trail is everything. Case 3. Account takeover with inadequate device controls. A customer's credentials are phished via a fake bank email. The attacker logs in from an unrecognized device, but your risk engine does not flag it because it is not properly calibrated. The attacker passes a weak SCA step and moves funds. The customer reports it. Under PSR, this is a PSP liability case. The customer did not authorize the transaction. The attacker did. But even if you argue the customer was partly responsible for credential exposure, the inadequate fraud prevention mechanisms, weak device risk scoring, and poorly calibrated SCA shift liability firmly to the institution. Fix the controls, then defend them. Case 4, the borderline case. A customer receives a prominent specific fraud warning on a high-value new payee payment. The warning names the specific risk type. The customer presses through it 3 times with explicit confirmation. The payment goes out and it is a scam. Under PSR, what happens? This is where PSR has nuance. If your warnings were prominent, specific, and demonstrated that the customer was made genuinely aware of the fraud risk, and if they exercised what amounts to gross negligence by proceeding anyway, the liability outcome may differ from a case where no such warning existed. But, and this is critical, the burden to prove the warning was adequate falls on you. Document everything. Here is how to translate PSR liability rules into operational policies. Your reimbursement policy needs to define which fraud typologies fall under the impersonation rule, what evidence is required from the customer, what timelines apply for assessment and payment, and how cases are escalated to supervisors when there is a dispute. Your complaint handling scripts need updating too. Customer support agents are often the first to receive an impersonation fraud report. They need to know how to capture the right evidence, what was said, what was done, when police were contacted, and they need to know what to tell the customer about PSR's reimbursement expectations. A poorly handled first contact can create legal and reputational exposure. And senior executives and board members need new metrics. Fraud loss rates by typology, reimbursement rates for PSR-covered cases, proportion of APP cases involving impersonation, and the performance of specific controls like VOOP and SCA are all PSR-relevant numbers. Supervisors will ask for them. You should have them before supervisors ask. I want to hear from practitioners. Which of the 4 case types I described is the most common at your institution right now? Impersonation calls, investment scams via platforms, account takeover with control gaps, or the borderline customer override scenario? Comment below. It helps me calibrate how deep the next deep dive goes. Let me leave you with 3 diagnostic questions to take back to your team. 1. Does your institution have a documented position on how you will handle impersonation fraud reimbursement under PSR? 2. Have you mapped your top app and impersonation typologies to PSR's liability expectations? 3. If a supervisor asked you to demonstrate that your fraud prevention mechanisms are appropriate, could you do it with data? I have a detailed breakdown of PSR's fraud liability provisions, including an annotated version of the impersonation rule and a sample liability decision flow chart at DaVinciDiligence.com. Link is in the description, and every episode in this series is available on our Spotify podcast, DaVinci Diligence, if you prefer to listen on the go. If this episode helped you connect PSR's liability rules to your operational decisions, subscribe. Episode 3 is next, and it covers verification of payee in detail, the name matching logic, the UX decisions that determine whether VoP actually stops fraud, and how VoP signals feed your AML models. Share this with your fraud, legal, and product colleagues. See you in episode 3.